If modern American politics can be reduced to a single force, it is not ideology, identity, or even party loyalty. It is the economy as people experience it in their daily lives. That reality explains why an overwhelming majority of voters who supported Donald Trump said the economy was the decisive factor in their vote. Not abstract economic theory, not long-term projections, but the simple question of whether life feels harder or easier than it used to. That question now sits at the center of American political life, because the economy is sending signals that directly contradict one another. Depending on which data point you look at, the United States appears to be either thriving or quietly slipping towards something more dangerous. 9 months into Donald Trump's second term, the country is facing an economic moment that resists easy labels. It is not a recession in the traditional sense. It is not a boom in the way Americans have historically understood prosperity. It is something in between, unstable and unresolved, marked by growth that feels distant and costs that feel immediate. On paper, the national unemployment rate sits at 4.3%. In isolation, that number suggests strength. For decades, economists believed unemployment below 5% was essentially full employment. Politicians once celebrated numbers far worse than this as proof of success. But averages conceal as much as they reveal. Beneath that headline number lies a labor market fractured by age, education, and security. Among young Americans between the ages of 16 and 24, unemployment stands at 5%. That is not a rounding error. It is a warning sign. For millions of young people, this is not an economy of opportunity. It is an economy of waiting. At the same time, job growth has slowed to a crawl. In August, the economy added just 22,000 jobs, a figure so small that it barely registers in a nation of more than 300 million people. Even more troubling, revised government data revealed that nearly 1 million fewer jobs were created over the past year than previously reported. These revisions matter because they expose momentum that never existed. They quietly rewrite the recent past. While job creation weakens, trade policy has moved aggressively in the opposite direction. According to the Organization for Economic Cooperation and Development, the overall U.S. tariff rate on imports now sits at 19.5%. That level is historically high, especially for an economy as large and globally integrated as the United States. Tariffs are often framed as tools of leverage or patriotism, but for consumers they function as a hidden tax. They raise costs before goods ever reach store shelves. Those costs then ripple outward through supply chains, adding pressure at every stage until they land, invisibly, on the consumer. This is why everyday prices have climbed so sharply. Coffee, bananas, televisions, toys, clothing, auto parts, electronics. These are not luxury items. They are fixtures of modern life. A single data point illustrates the reality more clearly than any political argument. Last year, a pound of ground coffee cost an average of $6.31. Today, that same pound costs $8.87. That is a 33% increase in a single year. For millions of Americans, this is not an abstraction. It is their morning routine. Economists across the political spectrum agree on something rare. These pressures are not temporary. Some prices spike immediately. Others are delayed by contracts and inventory cycles. But tariffs do not disappear. They accumulate, they compound, and over time, they harden into the baseline cost of living. Under normal circumstances, this combination of slowing job growth, rising prices, and trade uncertainty would point clearly toward economic trouble. Yet this is where the story becomes deeply counterintuitive. Despite all of this, the American economy is growing. According to the Commerce Department, GDP expanded at nearly 4% in the second quarter, significantly stronger than previously reported. The stock market has hit record highs repeatedly, logging nearly 30 new peaks in a single year. Small business confidence is rising. Corporate profits remain strong. The question becomes unavoidable. How can all of this be true at the same time? How can job seekers struggle while GDP surges? How can households feel poorer while markets celebrate? How can inflation feel relentless while official numbers claim improvement? This is the central paradox of the current American economy. It is not merely confusing, it is politically combustible. Presidents have always tried to claim credit for good economic news and deflect blame for bad news. That pattern has intensified in this moment. When growth numbers rise, the White House highlights leadership and policy success. When job numbers disappoint or prices spike, responsibility is pushed forward or backward in time. Economists like Jason Furman are correct when they say presidents receive too much credit and too much blame. The economy is vast, global, and influenced by forces no administration fully controls. But that does not mean policy choices are irrelevant. In fact, this administration is not merely managing inherited conditions. It is reshaping the economic landscape through deliberate, high-risk experiments. Trade policy has been transformed through aggressive tariffs. Tax policy has been locked in, providing clarity for businesses but also permanence. Deregulation is promised, though its scope remains uncertain. Businesses know what their tax obligations will look like next year. They do not know what their supply chains will look like. They do not know how foreign governments will respond. They do not know how long consumers can absorb higher prices. Uncertainty has become the defining feature of the economy, and uncertainty changes behavior more powerfully than fear. Companies that are profitable are not laying off workers en masse. They remember how painful it was to rehire after the pandemic. They want to keep their experienced staff, but they are also not expanding aggressively. They are delaying new projects. They are freezing hiring. They are holding cash. This Worgen tep scraps. They are on it in Sepanes. They are delaying new projects. This creates an economy that appears stable while quietly excluding newcomers. An economy where insiders are protected and outsiders are locked out. An economy that grows on paper while opportunity contracts in practice. This is why economists increasingly describe the current labor market as neither strong nor weak, but stalled. It is a paused economy, a waiting economy, a system holding its breath. For young Americans and first-time job seekers, that pause is devastating. For older workers, it feels like fragile stability. For corporations, it feels prudent. For politicians, it is nearly impossible to explain. The deeper problem is that traditional economic indicators no longer align with lived experience. GDP measures output, not security. Stock markets measure corporate profitability, not household stress. Unemployment rates measure joblessness, not fear of job loss or inability to move. People do not experience the economy as a spreadsheet. They experience it as pressure. Pressure at the grocery store. Pressure at the gas pump. Pressure in rent notices. Pressure in insurance renewals. That pressure has accumulated for 5 years, beginning with the pandemic, and never truly receding. Even as inflation slows on a year-over-year basis, prices remain dramatically higher than they were before. That difference has reshaped household budgets permanently. This is why political messaging focused on declining inflation rates fails to resonate. People are not comparing prices to last year. They are comparing them to a life they remember. This gap between economic narratives and economic reality is eroding trust. It explains why voters who blame the previous administration for high prices are often willing to wait patiently under the current one. Promises of a return to a familiar past carry emotional power, even when the path is uncertain. The economy, in this moment, is not simply about numbers. It is about belief. Belief that waiting will be rewarded. Belief that disruption will eventually produce stability. Belief that sacrifice today will produce relief tomorrow. Whether that belief holds may determine not only the political future of the country, but its economic one as well, the economy that makes no sense anymore. To understand why the American economy feels broken to so many people, you have to move away from charts and toward kitchens, checkout lines, rent statements, and insurance notices. This is not an economy that people experience in percentages. It is one they experience in disbelief. The most powerful force shaping public perception right now is not unemployment or GDP growth. It is affordability, more specifically, the cost of things people cannot avoid. Food, housing, healthcare, childcare, utilities, These are not discretionary expenses. You cannot opt out of eating. You cannot skip shelter. You cannot gamble with health insurance if you have children or chronic conditions. And you cannot simply stop paying electricity without consequences. Over the past 5 years, these costs have risen in a way that permanently altered household math. Auto insurance is up roughly 60%. Shelter costs are up more than 50%. Electricity has climbed nearly 40%. Healthcare premiums and deductibles have surged quietly, often masked by employer plans that absorb increases until they suddenly don't. During that same period, wages rose roughly 20%. That gap explains everything. It explains why people feel poorer even when they are employed. It explains why savings evaporated. It explains why credit card balances exploded. It explains why optimism collapsed even as markets climbed. People do not experience inflation as a rate. They experience it as accumulation. Every increase stacks on top of the last one, never resetting, never rolling back. When economists say inflation is cooling, what households hear is that prices are now rising more slowly from a level that already feels unbearable. This is why political arguments about year-over-year inflation have lost their power. A 2 or 3% increase feels irrelevant when prices are already 30, 40, or 50% higher than they were before the pandemic. People are not waiting for prices to stabilize. They are waiting for them to come down. And that is something modern economies rarely deliver. Deflation, in the sense most people imagine it, is economically dangerous. Falling prices often signal collapsing demand, rising unemployment, and deep recession. So policymakers aim for steady inflation, not reversals. That creates a permanent tension between economic stability and public satisfaction. Prices stay high. Wages struggle to catch up. And people are told, this is success. The result is a sense of betrayal that cuts across party lines. When voters say the system is not working, they are not making a philosophical claim. They are describing arithmetic that no longer adds up. Their paychecks vanish faster than they arrive. Emergency savings never materialize. Unexpected expenses feel catastrophic. Recent surveys show that only about 46% of American adults have enough emergency savings to cover 3 months of expenses. 30% have some savings, but not enough. Nearly 1 in 4 have none at all. Those numbers reveal an economy where a significant portion of the population lives perpetually on the edge of crisis. A flat tire, a broken appliance, a medical bill. Any one of these can trigger financial freefall. In practical terms, that means millions of Americans are already living in recession conditions, regardless of what GDP reports say. This fragility shapes behavior in subtle but powerful ways. People delay medical care. They avoid job changes even when unhappy. They stop saving for retirement. They rely on credit for essentials. They feel constant anxiety even during periods of nominal growth. And anxiety changes politics. This is where the contradiction between Wall Street and Main Street becomes impossible to ignore. While households struggle to manage rising costs, the stock market continues to set records. Indexes climb. Portfolios swell. Headlines celebrate. But the stock market does not represent the average American household. It represents corporations and investors. Roughly half of Americans own no stocks at all. Many who do own stocks hold them indirectly through retirement accounts that feel distant and inaccessible. For those households, stock market gains are theoretical. Grocery bills are not. This disconnect fuels resentment, particularly when political leaders cite market performance as evidence of success. To someone choosing between rent and groceries, record highs feel insulting. Yet from a corporate perspective, the optimism makes sense. Companies have learned to operate in high-cost environments. They automate, they consolidate, they cut inefficiencies. They leverage pricing power where they can. Many passed price increases aggressively during the pandemic and emerged more profitable than before. Now, facing consumer resistance, they are more cautious. They absorb some costs instead of passing them on. They protect margins through scale and technology rather than expansion. This is why corporate profits remain strong even as consumers feel squeezed. Businesses adapt faster than households can. It also explains why the stock market responds positively to artificial intelligence. AI promises efficiency without labor expansion. It offers growth without hiring. For investors, that is ideal. For workers trying to enter the labor market, it is ominous. Artificial intelligence has become the dominant story driving market optimism. Trillions of dollars have flowed into companies positioned as AI leaders. The narrative is seductive. AI will transform productivity. AI will revolutionize industries. AI will unlock growth unseen since the Industrial Revolution. There is truth in this. AI is a powerful tool. It accelerates research. It automates routine tasks. It enhances decision-making. But it also reshapes the labor market in uneven ways. The earliest impacts are being felt at the bottom rung. Entry-level roles that once existed to train workers are disappearing. Tasks that justified junior positions are now handled by software. Companies still need experienced professionals, but fewer apprentices. This creates a paradox. Productivity rises, but opportunity narrows. From a macroeconomic standpoint, this looks efficient. From a social standpoint, it is destabilizing. The labor market becomes segmented. Insiders thrive, outsiders wait. This segmentation feeds into the broader sense that the economy works for some, but not for others. That belief, once entrenched, is difficult to reverse. Political loyalty becomes conditional. Patience becomes transactional. People are willing to wait only if they believe improvement is coming. This is where leadership messaging becomes critical. When leaders promise a return to a past that people remember as more stable, that promise resonates even if the path is unclear. Familiarity feels safer than complexity. This helps explain why some voters tolerate economic pain under one administration that they rejected under another. Perception matters as much as policy. Trust shapes tolerance. There is also a psychological dimension that often goes unmeasured. Many Americans compare their current situation not to national averages, but to their own past. They remember when rent consumed a smaller share of income. They remember when groceries felt manageable. They remember when unexpected expenses were inconvenient, not catastrophic. That memory becomes a benchmark, and by that measure, the economy feels worse even when certain indicators improve. The longer this gap persists, the harder it becomes to bridge. Economic narratives lose credibility. Experts sound disconnected. Institutions feel distant. This is why economic contradictions are not just confusing, they are corrosive. An economy that grows without delivering relief risks losing legitimacy. People may continue to participate, but they stop believing. And once belief erodes, politics becomes volatile. The danger is not collapse. It is stagnation paired with anger. An economy that does not clearly fail also does not clearly succeed. It lingers in a gray zone where pressure builds slowly, unevenly, and persistently. That pressure is now shaping everything, from consumer behavior to voting patterns to generational trust. And it raises a question that cannot be avoided much longer: the economy that makes no sense anymore. If rising prices explain why people feel strained, debt explains why the strain hasn't yet snapped. The modern American economy has not collapsed under pressure because households have been quietly borrowing to survive. That borrowing has become the invisible stabilizer of consumer spending and the hidden risk beneath it. Consumer spending remains one of the strongest pillars of the economy. It is a major reason growth numbers remain positive and why the economy expanded so quickly in the second quarter, according to data from the United States Department of Commerce. Despite everything, people are still buying. They are still traveling. They are still filling carts and clicking checkout. But the way they are paying has changed. Credit card balances have climbed to record levels. Interest rates on those balances hover near 20%, a level that would have shocked previous generations. Buy now, pay later. Services have exploded in popularity, becoming one of the fastest-growing segments of financial technology. These tools are not inherently bad. Used carefully, they can smooth cash flow and help households manage timing mismatches between income and expenses. But when used to cover essentials rather than conveniences, they become something else entirely. Surveys now show that a growing share of buy now, pay later usage is going toward groceries, takeout, and household necessities. That is a red flag. Financing food is not consumption smoothing. It is distress. The danger lies in how frictionless this borrowing has become. A single tap on a phone replaces the physical act of handing over cash. There is no moment of pause, no tactile reminder of limits. Spending feels abstract, while debt becomes concrete later, often at punitive interest rates. Once a payment is missed, costs escalate quickly. Interest rates spike, fees accumulate. What began as convenience turns into entrapment. This dynamic allows consumer spending to remain strong even as financial stability weakens. It keeps GDP elevated while household balance sheets deteriorate. It creates the illusion of resilience. The economy, in effect, is borrowing time from the future. This helps explain why traditional warning signs have not yet triggered a downturn. People are still spending, not because they are comfortable, but because they are cornered. Bills must be paid. Children must be fed. Life continues, regardless of economic conditions. At the same time, a very different behavior is emerging among higher-income households and corporations. Cash is piling up in money market funds at record levels. Trillions of dollars now sit in these vehicles, earning relatively safe yields of around 4%. This tells a crucial story. On one side of the economy, households are borrowing at 20% to survive. On the other side, investors are parking money safely, waiting. That gap captures the unequal nature of the current moment more clearly than any single statistic. Those with assets are cautious but comfortable. Those without assets are stretched and exposed. Money market balances signal uncertainty. They suggest that investors do not fully trust the durability of the rally. They are participating in gains through stocks and retirement accounts, but they are keeping cash close at hand, liquid, ready. This is not the behavior of an economy brimming with confidence. It is the behavior of an economy hedging against surprise. In previous eras, such large cash hoards would have been interpreted as pessimism. Today, they coexist with record highs in equity markets. Another contradiction layered atop many others. This coexistence is possible because the stock market is not forecasting conditions for households. It is pricing expectations for corporate earnings. And corporate America has proven adept at navigating high-cost environments. Companies have learned to protect margins through consolidation, automation, and pricing strategy. They have diversified supply chains. They have shifted production where possible. They have passed on some costs and absorbed others. Households do not have those tools. A family cannot automate childcare. A renter cannot negotiate shelter costs the way a corporation negotiates input prices. A patient cannot outsource medical care. This asymmetry creates a widening gap between corporate performance and personal experience. The political danger lies in how long that gap persists. People can tolerate hardship if they believe it is temporary. They can endure sacrifice if they trust that improvement is coming. What they struggle to accept is permanence. When price increases feel locked in, when wages lag indefinitely, when debt replaces savings as the norm, when opportunity narrows rather than expands. At that point, economic frustration transforms into something more volatile. Another factor amplifying this volatility is the erosion of economic mobility. In past decades, rising costs were often offset by rising opportunity. Young workers could expect to move up quickly. Changing jobs usually meant higher pay. Career ladders felt climbable. In the current environment, mobility has slowed. Job switching has declined. Hiring freezes trap workers in place. Wage growth concentrates among those already established. This stagnation compounds over time. It delays wealth accumulation. It postpones home ownership. It reshapes family formation. It deepens generational divides. Older workers, protected by tenure and experience, often feel the economy is holding together. Younger workers, locked out or stuck, experience it as fundamentally hostile. This divergence explains why economic sentiment varies so sharply by age, even when headline numbers look stable. It also explains why political narratives fracture. One group hears reassurance and nods. Another hears dismissal and grows resentful. None of this shows up cleanly in economic dashboards. Confidence indices rise and fall, but they struggle to capture fear. Employment rates stabilize, but they ignore stagnation. Inflation cools, but prices remain high. The economy as measured is functioning. The economy as lived is exhausting. This exhaustion does not announce itself with crashes or mass layoffs. It accumulates quietly. It manifests as anxiety, debt, delayed decisions, and diminished trust. Before we wrap up, here's one last thing. If this breakdown helped you see the economy more clearly, if it gave you language for what you've been feeling but couldn't quite explain, then make sure you don't miss what comes next. These issues aren't going away. And the next chapters of this story are already unfolding. If you found value in this video, hit the like button. It helps more people find this content and keeps these conversations alive. And if you want clear, honest explanations about money, markets, politics, and the forces shaping your everyday life, subscribe to the channel. New long-form breakdowns are coming, and you won't want to miss them.